Hello and welcome back to another episode of Market Brief After Hours. We have a lot to unpack. If you looked at your portfolio today, you might have wanted to close the app immediately. It was a sea of red out there.
That is putting it mildly. It was a proper risk-off day. We saw a renewed rout in technology shares, a total collapse in cryptocurrencies, and to top it all off, fresh signs that the labor market is cracking. Investors really didn't have anywhere to hide today.
It feels like the sentiment shifted incredibly fast. Just a few weeks ago, we were talking about record highs, and now we are talking about recession fears. Let's start with the big picture in the U.S. What did the major indices look like at the close?
It was ugly across the board. The selling pressure was intense, and it really accelerated as the day went on. The Dow Jones Industrial Average dropped sharply. It finished down 593 points, which is a 1.2% decline. It closed at 48,909. At one point, it was actually down nearly 700 points, so we barely clawed back anything.
And that wiped out a lot of the early year gains for the Dow, right?
Exactly. It's erased much of that progress. But the S&P 500 is where the psychological damage really hit. The S&P declined 1.23% to close at 6,798. That move actually pushed the benchmark into negative territory for the year 2026.
That is a significant psychological blow for investors, seeing the year-to-date return flip red.
It is. And the Nasdaq Composite took the hardest hit, as it usually does in these tech-led sell-offs. It slid 1.59% to finish at 22,541. The issue there was the mega-cap stocks and chip makers coming under renewed pressure.
Let's dig into that tech weakness. We've heard so much about artificial intelligence driving this market for the last 2 years. Is the shine coming off the AI apple?
There is definitely growing skepticism, not necessarily about the technology itself, but about the cost. Alphabet really spooked the market today. They forecasted up to $185 billion in capital expenditure.
$185 billion? That is a staggering amount of money.
It's massive. And investors are looking at that number and asking, where is the immediate return on investment? It's fueling anxiety over profitability and valuations. When you combine that with Qualcomm taking a sharp decline, it just soured the mood for the entire semiconductor and software space.
So tech is struggling with high spending, but you mentioned the labor market earlier. Usually, bad economic news is good news for stocks because it means interest rate cuts. That dynamic didn't play out today?
Not today. We've reached the point where bad news is just bad news. The data reinforced fears that we are sliding toward a recession. Initial jobless claims rose to 231,000, which was higher than expected. But the scarier number was the layoffs.
What are we looking at there?
According to the Challenger report, January layoffs reached their highest level since 2009.
Since the great financial crisis?
Yes, and job openings have fallen to 6.54 million, the lowest since September 2020. We are seeing declines in professional services, retail, and finance. This isn't just one sector anymore. Because of this, Treasury yields fell. The 10-year yield dropped to 4.198%, and the 2-year slipped to 3.467%. The bond market is screaming that the economy is slowing down rapidly.
It sounds like the soft landing narrative is taking a beating. Now, usually when stocks panic, people look for alternative assets. But crypto holders had a terrible day, too.
Terrible is an understatement. It was a bloodbath for digital assets. Bitcoin plunged over 13% in a single day. It dropped about $9,736 to close at $63,597.
That is a decisive break below the $70,000 support level we've been watching.
It is. And if you zoom out, Bitcoin has now shed nearly half its value from its October peak, which was above $126,000. The argument that it's a store of value is really being tested right now. And obviously, the crypto-leaked equities got crushed. Strategy was down 17%, Coinbase fell 13%, and Robinhood slid 10%.
So no safety in tech, no safety in crypto. Let's look overseas. Did Europe fare any better?
No, the pullback spilled right over. European equities ended firmly lower. The Stoxx 600 was down almost 1.1%.
We also had some central bank decisions in Europe today, didn't we?
We did. The Bank of England held rates at 3.75% in a very tight 5-4 vote, and the ECB maintained its deposit rate at 2%. Neither decision did anything to revive risk appetite.
How did the specific country indices look?
The UK's FTSE 100 fell 0.90% to 10,309. The CAC 40 in France slipped 0.3% to 8,238. But Italy took a hard hit. The FTSE MIB dropped 1.75% to 45,820. Germany's DAX also eased off 0.5% to 24,449.
And I assume Asia followed Wall Street's lead.
They certainly did. South Korea's Kospi plunged nearly 4%, 3.86% to be exact, closing at 5,164. That was driven by Samsung and SK Hynix, tracking that U.S. tech weakness we discussed. Japan's Nikkei fell 0.88% to 53,818. It was a global risk-off wave.
We're going to take a very short break. When we come back, we're going to look at commodities, specifically a massive move in silver, and we'll break down the Forex markets with those key moving averages you need to know. Stay with us. Welcome back to Market Brief After Hours. We've covered the equity carnage and the crypto crash. Let's turn to commodities. Usually, when geopolitical tension is high, oil spikes, but we saw the opposite today.
That's right. We actually had some de-escalation news. The U.S. and Iran agreed to hold talks in Oman. That cooled down the supply concerns immediately. Brent crude settled down 2.75% at $67.55 per barrel, and WTI declined 2.84% to $63.29.
So geopolitical risk premiums are coming out of the oil price. What about gold? That's the classic safe haven. Did it shine today?
Surprisingly, no. Gold extended its sharp pullback. It settled at $4,811, down 3.08%. It's a corrective move from record highs, but it's still holding above the major moving averages. However, the real story in the metals market was silver.
I saw that chart. It looked like a cliff edge.
It really did. Silver plunged 16.67% to close at $73.48. It collapsed from over 88.
That is incredible volatility for a major commodity.
It pushed the price decisively below the 50-day simple moving average, SMA, which was sitting at 76.14. That is now a key resistance level. If silver can't reclaim that 50-day average quickly, the outlook remains very vulnerable.
Speaking of moving averages, let's get technical with the Forex market. Currency traders are watching these levels closely. Let's start with the euro against the dollar.
The Euro USD pulled back a bit, closing down 0.22% at 1.1781. It's retreating from multi-month highs, but technically the bulls are still in charge for now.
Why do you say that?
Because it remains firmly above its key moving averages. The 50-day SMA is at 1.1725, the 100-day is at 1.1679, and the 200-day is at 1.1615. As long as the pair holds above that 1.1725 support zone, the broader bullish trend is intact.
Okay, so the euro has some breathing room. What about the British pound?
The picture for GBP USD is a bit darker. The pair ended at 1.3538, down 0.84%. Crucially, it slipped below its 50-day SMA, which is at 1.3480.
That's a bearish signal.
It is. It's now trading in a dangerous zone between its 100-day and 200-day averages. Short-term momentum has weakened significantly. Resistance is up near 1.3700, but if we see sustained weakness below 1.3538, this corrective phase could deepen.
And quickly, euro GBP?
That pair actually rebounded, rising 0.73% to 0.8702. It moved back above its 200-day SMA and is testing the 50-day average at 0.8707. If we get a sustained close above that 0.8707 level, it would strengthen the reversal signal.
Let's wrap up with the Aussie dollar.
AUD/USD slipped 0.76% to 0.6943. It's a corrective retreat, but the medium-term trend still favors the upside. The key support to watch is the 50-day SMA, which is way down at 0.6724, so it has plenty of cushion before the long-term trend is threatened.
Before we go, we have to touch on the individual market movers. It wasn't all bad news, was it?
There was one bright spot, McKesson.
The medical supplies distributor?
Yes, the stock jumped 16%. They beat top-end earnings estimates and raised their full-year guidance. In a market like this, investors flocked to that earnings certainty.
But on the consumer side, Estée Lauder had a rough day.
Rough is putting it lightly. Shares plunged 19%. Even though they beat earnings expectations, their guidance was very cautious. Investors are terrified of weak sentiment in the consumer sector right now.
And we mentioned the tech route earlier, but looking at the specific names, cybersecurity really took a hit.
It was a dumping ground for high-valuation software. CrowdStrike fell more than 9%, Zscaler dropped over 8%, and Palo Alto Networks was down more than 7%. When risk appetite vanishes, these high multiple stocks are the first to be sold.
And finally, Amazon. They reported earnings, and the market reaction was mixed?
Mixed to negative. Amazon fell more than 4% in regular trading and dropped another 8% after hours.
What was the catalyst there?
Similar to Alphabet, a higher spending forecast. They had mixed earnings, but that guidance on spending just added to the fears that big tech is spending too much without guaranteeing immediate profit growth.
It seems like capital expenditure is the new scary word for Wall Street.
Absolutely. So to summarize the day, we have a tech sell-off driven by spending fears, a crypto collapse, and economic data suggesting a recession might be closer than we thought.
And all eyes are now on next week.
Yes, the BLS jobs report next week is going to be the main event. The bond market and the Fed will be watching that like a hawk. Until we see some stabilization there, markets are likely to remain very volatile.
Well, we will be here at Track and All for you. That's all we have time for today. If you found this useful, please follow Market Brief After Hours for your daily dose of financial clarity. Thanks for listening.